Hi, class. So we're back at it again. We jumped last time from chapter 7 to 13 because 13 is so crucial for our projects, and it's kind of the capstone in the analysis of which we've done many of the formulas already, many of the ratios, but it's the big picture and the understanding that we want to get to. So now we're back on chapter 8. We're diving deeper into fixed assets. So let's talk a little bit about fixed assets. What do we want to do with fixed assets? Well, if we look at what we're trying to do, we're trying to get into an environment where if something's going to last for more than a year and it's a pretty big ticket, we record it as an asset. And then we need some sort of mechanism to transfer the value of that asset over a predetermined time period into expenses. And we call that depreciation for fixed assets. And we call it amortization for intangible assets, which we'll get to at the end of this video. But our fixed assets are things like land, building, machinery, equipment, vehicles. Now, land we never depreciate, but everything else I just mentioned does get depreciated. And there are different ways of handling it. So if I told you I had $1 million building and we're going to depreciate it over 10 years, well, $1 million divided by 10, that's $100,000 in expense a year, depreciation expense. If I told you we're only going to depreciate that $1 million building over 5 years, you'd say that 100,000 jumped up to 200,000. That 200,000 would be more expense, less net income. That could have a pretty significant impact. Or how about if I said 40 years? I think officially the IRS says 39 years is how long we depreciate buildings. And then how about a car? We get a vehicle and we try to depreciate the vehicle, but what we depreciate and the value of the car may or may not be a match. So we may think we're going to use it for 10 years, but the value of the car we drove off the lot, it lost 10 or 15% of its value. So those are things we need to account for, and there are different reasons for using different methods of depreciation. So let's talk about those depreciation methods and things. So we got a plant asset. It's tangible in nature. It's something we can touch. It's actively used in operations. It's not inventory. It's not like a car dealer that sells cars is going to put cars in inventory. Whereas a manufacturer that buys cars for their sales staff or for use in the factory, that's going to be depreciated and that's going to be a fixed asset. A building is going to be a fixed asset for most businesses, except for a real estate business. It might be considered inventory. They're buying it to resell. They're not using it as such. So most likely the buildings they purchase will be considered inventory, not fixed assets. But for the rest of us that have businesses that are not real estate, we're fixed assets. They're actively used in operations. They benefit future periods. If it all gets used up this year, buy a gallon of milk, it's this year. We go out and buy raw materials, we use them up this year. Anything that's going to be used this year is not going to be over a period of time, so we don't have to capitalize it, put it as a capital asset. So PP&E, property, plant, and equipment, are the buzzwords that go with that. 4 issues. We've got a cost, historical cost when we buy the thing. We have the use, the allocation cost over the periods benefited. So maybe a vehicle lasts for 4 years. Account for subsequent expenditures. So we might have oil changes on the vehicle. We might have a new engine we pop into a truck. And then we have disposal, record the disposal, getting rid of the asset, getting rid of the depreciation, and maybe recording a gain or loss. If we sell it, we'll just write it off. So those are the things we need to measure and account for when we analyze. Now, we're going to have a building on our books, maybe it's $100,000. In 20 years from now, the building might be worth $200,000 or $300,000. But the value of that building is going to keep going down, 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 not appreciating because the market, that's a fair market value, no relationship to the actual historical cost and the book value. So we're going to be calculating book value the same we did for receivables. We took our accounts receivable less the allowance for doubtful accounts to give us our book value, our net realizable value for AR. We're doing the same thing with equipment, take accumulated depreciation, and the net of that is going to be the book value of whatever asset we have that we're depreciating on the books. So what's the cost? Well, we got a purchase price, and then we have things we need to do. We might have to build or construct or pay transportation. We might have to pay for training, anything associated with getting the asset up and running. Piece of machinery, we might have to take out a window and put a piece of machinery through the windows into our building and the costs associated to do that are all part of the costs that we need to capitalize and depreciate. When I built a building, I built a 22,000 square foot building. Ultimate cost was about 1.4 million. We sold it for about 2.3 million. But the architectural costs and design costs, those had to go into the capitalization of the building, and we depreciate it. We couldn't say, oh, we paid the designer, the architect, $22,000. Let's expense it this year. No, we had to add that $22,000 to the total price of the building. And then 39 years worth of depreciating, pull that out. Machinery, equipment, purchase price, taxes, transportation charges, insurance while in transit, installing, assembly, and testing. Actually, one other thing on the acquisition, I had to take out a construction loan. It was new construction. I had to add the interest expense during the 6 months of that construction loan to the total value of the building. I could not deduct that interest expense in the year I paid it. I had to deduct that interest expense as I depreciated the building over those 39 years. So installing, assembling, testing, those are all part of the initial costs associated with machinery equipment. It gets added to the total value when you do that. Buildings, we talked about title fees, attorney fees, brokerage fees, cost of purchase of construction, and capitalization of interest, like I mentioned, and taxes as well. Land improvements. So I told you land is not depreciable, but I'll tell you the driveway and the parking lot is. The lights you put in the parking lot are, because those will deteriorate. You will need to repave eventually. They will get used up. In theory, land doesn't get used up. We'll talk about mineral rights and oil and mining for gold later on. But basically, land improvements are also depreciable over the useful life of the improvements themselves. Land, as we said, land is not depreciable. But there are also things that we get associated with the land that we bought, surveying fees, real estate commissions, purchase price, those will all get added to the land, and we can't depreciate or expense that until we adjust when we sell it. So depreciation is the process of allocating costs in a reasonable and predictable manner over the period of time that you receive the benefit from it. So acquisition cost, and then we have our income statement. So we're moving it from the balance sheet over to the income statement through depreciation expense and a contra asset called accumulated depreciation, offsetting. So what determines depreciation? Well, for straight line, we have cost, salvage value, and useful life. So we might have bought a vehicle for 20 grand. At the end of 4 years, it's worth 5. So we have to depreciate $15,000 over that 4 year, so that our net book value at the end of the 4 years is going to be the same 5,000 that we determined to be the salvage value. Not the case with some of the accelerated methods. You don't worry about salvage value and calculating the depreciation at that point. We'll see that in a few minutes too. The straight line, the units of production, and declining balance. Units of production, let's say we bought a Mack truck and we anticipate 500,000 miles that we're going to get on this truck. Not 4 years, not 10 years, not 2 years, but 500,000 miles. You go ahead and say, well, how many miles did we drive this year? Oh, we drove 100,000 miles. 100,000 out of 500,000, that's 20%. So we'll depreciate expense. The depreciation expense for that year would be 20% of the truck value. If the next year we drove another 250,000 miles, used it every day and drove like crazy, then we'd actually take another 50% of the value of the asset out of the picture. And declining balance, we'll see how that works. That's required for tax purposes pretty often. So here's our depreciation in straight line example. So I got a cost of $10,000, I have a $1,000 salvage value, and a 5-year useful life. Take the 10,000 minus the 1,000, that's 9,000 divided by 5 years. I get $1,800 a year. And over those 5 years, for a full year, you take depreciation expense, debit the $1,800, and credit the contra asset account accumulated depreciation, shows up on the assets, but I offset to the assets, the credit balance of $1,800. So we're getting stuff on the income statement that's reducing net income. That's also reducing retained earnings in the equity section. And we're reducing our assets by that same amount. That's how the big picture works. Straight line, and on the balance sheet, we have the machinery less accumulated depreciation yields a net book value. year-end book value. Shows. Then the units of production I talked about. Talked about the truck, 500,000 miles. I'm assuming no salvage value. Total units of production was 500,000, and we're figuring out, well, how many units did we use? So we calculate out cost per mile, and if we do 100,000 miles, that's going to come out to 20% of whatever the original price was. And then we talk about something called MACRS, Modified Accelerated Cost Recovery System. That's how the IRS likes to do fixed assets. And we look at that and say, okay, MACRS, so we have something called 200% declining balance, 150% declining balance. We'll see, well, I want to play with that in a minute. We don't take out the salvage value when we do that, but we can't go below that salvage value as we depreciate. So we look at that declining balance method. We start with a straight line rate. If we did 5 years, that's 20% a year. 4 years will be 25% a year. And if we're doing double declining balance, we double that number. So in this case, on a 5-year amortization, 5-year depreciation schedule, we're going to go to not 20% a year, but 40%. So the first year, we're going to take 40% of the original amount of that $10,000. That's $4,000. Well, how much is now left? What's the net book value? We get 10,000 minus 4,000. We have a net book value of 6,000. You take 40% of that 6,000. Again, notice no salvage value. And we end up with, instead of 4,000, we end up with $2,400. So we look at the schedule here. We're taking, and I'll make it a little bigger. So, yes, I guess I can. So you'll see that the first year we take out 4,000. We took 40% of the 10,000. Then we're going to take out 40% of the 6,000 is 2,400. Then we take out 40% of the 3,600, which is 1,440. 40% of the 864. The only catch is we're not going to take 40% of 1,296. We're going to take the remainder to get to the 9,000 total expense. Remember, we had a $1,000 salvage value and a $10,000 price. So we can only get to 9,000 in depreciation expense total. So that's why this 296 came into play, not 40% of the 1,296. So we could do up to the 1,296, but 296 was all that was left. If we're doing straight line, let's say we bought an asset July 1. Well, we're going to take 6 months worth of depreciation. We're going to take half a year's depreciation on straight line. But here we have the MACRS telling us double declining balance. So if we compare depreciation methods, $9,000, different years, 1,800 straight line. Double declining was 4,000, 2,400, 1,440 down. And units of production was based on the usage. And our truck example was mileage. Machinery is often hours. You probably know airplanes. They don't wait 5,000 miles for an oil change, or 3,000 or 8,000. They based on number of hours of an engine to do an overhaul or to do maintenance. So it's hours. Even my lawn tractor records hours. That's how I know when to do an oil change. After 5 hours, the first one. After 100 hours, the second one. And thereafter. So I'm almost on my first one. Partial year, I just mentioned that if you acquired an asset July 1, you will take a half year's depreciation. This one asset was acquired October 1st. Count on your fingers. October, November, December. That's 3/12. That's 3 months. That's a quarter of a year. So our first year, we're going to take 10,000 minus 1,000. That's 9 divided by 5, 1,800, and multiply that by 3/12, a quarter of a year. The next year's a full year. The next year after that's a full year. The next year after that's a full year, and then a full year. And not the 5th year, but the 6th year is going to be 9 months worth of depreciation to make up for the 3 months taken in the first year. Sometimes we have a change in estimate. What happens if we put a new roof on a building? Or what happens if we think the building's going to last an extra 20 years, or we think it's going to be used up sooner and not last more than 15 years? Well, we change our estimate at that point in time, and based on the new information from here on out, we make the changes. We don't have to be retroactive and go back and change last year's and the years before, because if we did that with all the assets, it would be a mess. It would get crazy. But we can do changes because life changes. We can change from LIFO to FIFO or back and forth, FIFO to LIFO. but we can also change our depreciation estimated, except the IRS doesn't like you to do that. So a lot of small businesses will say, whatever the IRS does, that's the depreciation we're taking. I'm not going to have two sets of books. But legitimately, most companies will have multiple sets of books, books by GAAP. By the way, the IRS is not GAAP. They don't do general accepted accounting principles. They do tax law and tax research. And I'm not a tax accountant. That's not my field. I go to the classes every year for a day or two. I go to the marathons. But you ask me a tax question, I'm calling my accountant because that's not what I know best. I know some other things though. Asset impairment. What happens if we bought a CAT scan machine and it takes 5 people to run and it takes $100,000 in energy a year to run and it's supposed to last 10 years? But 2 years from now, we buy another CAT scan machine. It takes only $10,000 in energy a year to run, only 2 employees to run it. We're not going to be using that big asset, the big CAT scan machine, because there's too much maintenance and too many personnel. So that asset has now impaired value. We get to write off most of it, if not all of it. So we'll reduce the valuable expense, the part that is used and not available to us or reasonable. Maybe we ship it over to Russia or ship it over to Eastern Europe or ship it down to a country that needs it, that may not have it, that could use it better than we can. Then there's 2 kinds of expenditures, revenue expenditures and capital expenditures. Remember we talked about those oil changes? Well, oil change is a revenue expenditure. It doesn't add much to the life of the asset, although obviously it'll prolong the engine. But you expense it in the current period. I did an oil change. Great, it's an expense. I'm done. A capital expenditure, maybe I dropped a new engine, okay, or added a new exhaust system or transmission. Now that might extend the life, and I need to capitalize that and depreciate. So ordinary repairs, considered revenue expenditures, and betterments or extraordinary repairs, major overhauls, or extending the life beyond the original as a capital expenditure. And you do want to know the difference between those 2. So when we sell something, what happens? Let's take an example and look at selling something, okay? So if we go ahead, and I told you getting the assets over to the expenses, depreciation expense, you debit depreciation expense, and credit accumulated depreciation. Okay. All right. But if I go ahead and I want to go and take a look at, I'm going to cut out the drawing right now. And we go down and say, I have an asset. Let's say I have a vehicle on my books for $20,000 purchase price. I have accumulated depreciation so far of $15,000. I have a net book value of, you guessed it, $5,000. Now I sell this vehicle. I sell this vehicle for $10,000. The cash, $10,000. I need to clear a couple of things. I need to clear my accumulated depreciation. So I've got a credit balance, so I'm going to clear my accumulated depreciation for $5,000. I'm sorry, $15,000. That's no longer going to be there. And I'm going to clear the asset. I'll credit the asset, which is still on the books, of $20,000. I'm going to take it off the books. I sold it. Now I'm not in balance, am I? How much am I off by? Let's see, 25 here and 20 here. I have something going on here that I need to record $5,000 to balance it. Now, is this a gain or a loss? Well, expenses are debits, revenues are credit. This is a credit. I will tell you from experience, gain on sale of asset, $5,000. Okay, so I'm crediting it, and you can actually logically think about it, saying, I've got a book value of $5,000 here, and I sold it for cash of $10,000. That means I made $5,000. That's kind of logical. What happens if I sold it for $5,000? Well, 15, 20, I'd have 0 gain, 0 loss. What happens if I totaled it and I got zero cash and I wasn't insured, or I took off the collision. Well, now I've got to balance it the other way. Instead of a 5,000 credit or a zero credit or debit, I have to debit here $5,000. And you can see the book value is 5 and I got zero cash, so I have a loss on sale or disposal of assets. So you can see how that picture comes in. We're just clearing the books. We're getting rid of the vehicle. We're getting rid of the accumulated depreciation. We're maybe getting some cash sometimes, or trading, bartering it sometimes. And if we get cash, we've got to calculate the difference between the debits and the credits. And whatever that is, if it's a debit, it's a loss. And if it's a credit, it's a gain. So record, disposal, gain, loss, and we remove the asset from the books. It's no longer there. We no longer have it. We just totaled it. We sold it, whatever happened to it. Okay, if cash is greater than book value, you get a gain. Credit side, revenue side. Cash is less than book value, you record a loss. Left side, debit side, expense side. If cash equals book value, no gain or loss. We just saw that. We just demonstrated that. Natural resources, something called depletion expense. And usually we're depleting things, natural resources, oil, coal, gold, whatever comes from the land. And if we can determine how much is there total and how much we took out, just like our units of measure when we did miles for our truck or hours for our machine, we do the same thing here for depletion expense, for mineral deposits, oil, fracking natural gas. Okay. Let me get something called intangibles. What the heck are intangibles? Again, these are pieces of paper. These are rights and privileges to use something. They don't have a physical substance. They're not a computer. They're not a building. They're not the land. But it's a license. It's a copyright. It's a patent. It's something that will give us benefit over time and will get used up. And instead of calling it depreciation, we call it amortization. And by the way, there's no such thing as an accumulated amortization account. We just expense the amortization expense directly to the patent, directly to the copyright. That's how we book it. That's how we show it. And things like franchise fees as well. When you buy McDonald's or you buy a Burger King or a Wendy's, I prefer Wendy's myself, you will go ahead and you will have an expense associated with a franchise fee, but you get buy a 5-year license or a 10-year license. I bought a franchise. It was a 10-year franchise. Every year I took 1/10 of that and amortized it on the books. Trademarks, trade name. Goodwill. Goodwill is never amortized, by the way. Goodwill is when you acquire something for more than the book value, it's goodwill. It's not the nice goodwill you get if you do nice things for your customers. This is actual financial goodwill. There's a right of use asset, also known as a lease. Leasehold improvements. So you're leasing a building. You have a 10-year lease. You change the rooms. You're a medical practice. You're adding more running water and more electricity, dividing the rooms out for examination rooms. You got a 10-year lease and it's going to last 20 years. You go ahead and book that as a 10-year amortization of leasehold improvements. And then research and development, R&D, is expensed the year. It's always expensed in the first year. You do not stretch over R&D unless it's buying some equipment that's going to be used for other purposes besides R&D. But if you buy equipment, R&D purpose only, you expense it that same year. And then asset turnover is a ratio we want to make sure you're able to handle. It's net sales over average total assets. How many times do we sell our assets? We saw that in chapter 13 in my last lecture, and we're seeing it again here. I had $100 million in sales and $50 million in average total assets. I sold my assets twice. And that's the chapter. Hope you enjoy. Hope you're learning. I really sincerely hope you're getting comfortable with the concepts and understanding the flow and the story the numbers tell. That's what they do. They're telling you a story on how we're doing, where we're putting our resources, where we may need some more resources. And if I was an investor, I want to get involved with that company. Well, I'm going to look at the numbers, make sense of it. Financial statements are more historical in nature, more past in nature. When you take managerial accounting, if you do, you'll see that's more current, that's more decision-making, that's more operational for running the business today as it is. But we're doing financial statements, which by nature are historical, looking at the past, analyzing where we put our resources, and analyzing how our results were. So that's what we're up to. Thank you for your time, and I look forward to our next get-together. Have a good one.